Welcome to 100 units. Thanks for everybody being here. Really appreciate it. Our timer just went to 0. Now it's time to talk about multifamily financing instead of, I don't know, whatever the other adventures we were talking about. By the way, Nikki is watching our chat, so should you have any questions in the chat, she's happy to help move those in the right direction. And why are we talking about multifamily financing? Multifamily financing, it's interesting. Back when I started in this business in the 2008, 2009 timeframe, we didn't have to worry about multifamily financing because there almost was none available because lenders were very tight at that time. It was agency loans or nothing. So there wasn't, and they were being very conservative about what they lent on. Then we went through a time frame where things started swinging back, got all the way to, we were doing for a little while in like the 17, 18s, we were doing up to like almost 75, usually about 75% loan to value. And then now today's market, we've kind of swung back to where we're running about, basically the lenders bring about 2/3 of the capital and the investors bring about 1/3 of the capital is typically what we're seeing in the marketplace. And that's across most of our markets. So when we're talking about multifamily financing, we're actually talking about the lender that's bringing the vast majority of the capital to get any deal done. If you happen to want the full slides of this, you can follow us on Facebook and just direct message 100 units or me, and we'll send you the entire slides if anybody happens to want them. We're going to run through the importance of multifamily financing, what it is. And for me, one of the things that is very unique in the space of multifamily financing from other asset classes, industrial, office, retail, etc., is the fact that we specifically have quasi-government entities, Fannie Mae, Freddie Mac, and HUD, that are there with the sole purpose of providing liquidity to a market at all times. And that's one of the real unique things that multifamily financing has as an offer that the other asset classes do not. The vast majority of the deals we are doing right now are bank and credit unions. We are doing very few agency deals with the exception of cash out refinances. That most of the purchases by far have been bank and credit unions. One of the reasons for that is their interest rates are just a little bit more than agencies right now, especially when you're talking about small balance loans. They've got relatively flexible terms, high loan to value. They're giving significantly higher loan to values than most of the agencies are coming in. So we're talking 60 to 70% loan to value versus in the 50s to 60% loan to value. And a big one specifically in Florida is their insurance requirement flexibility. That is give or take savings of about 50% on the insurance cost, which has a large impact on the net operating income of a property. So that insurance requirement, it being the flexibility that it is, makes a huge difference in credit unions and banks versus agencies. Agency financing, these are quasi-government backed entities, Fannie Mae and Freddie Mac. I'm going to skip HUD because my experience with HUD has been limited. It takes a long time to get closed, even if you are very good at it. Now, it does have long-term rates, but that is a specific entity unto itself, and I have purchased exactly 0 deals where HUD has been involved. Fannie Mae and Freddie Mac, however, are much easier to work with. They have small balance programs for under $5 million. They have over $5 million is typically the rates that you're going to see advertised. They have this is the big thing that people love with them is they have non-recourse options. That's number one on the list. People are looking for a non-recourse loan. They're the first place to go. Really interesting that you can pick 5, 7, 10, 15, 20-year loans with them. Interest only periods, you can even go full term interest only, which is a really nice thing to have. 2 things that are very important to know about them. One, their insurance requirements are extremely strict. And make certain when you get your insurance quotes during your due diligence period, if the intention is to use a Fannie Mae loan or a Freddie Mac loan, you get a loan quote that is Fannie Mae or Freddie Mac compliant. Because if you have an insurance agent who sends you a loan quote to protect the, like, oh yeah, this will cover the property, when you go to closing, they are going to look for every single one of those items that they expect to see, and they better see them. Otherwise, you're not closing. And you can get a really bad surprise. I had a number of people who've gotten bad surprises because they used a insurance agent who didn't understand Fannie Mae and Freddie Mac requirements. Also, if your intention is to flip the property in the near term, in the next 3 years, your intention is to sell it, these loans can have really expensive exits. You will know ahead of time what their prepayment is or yield maintenance or what it is, but read that carefully because it is going to be exactly what is presented and it will not be anything less. So if your intention is a long-term hold, these can be excellent options. If your intention is anything shorter, I would go with something different. I went through the alternatives because there's a number of other non-bank lenders that are active today. One of the ones we've seen had some reasonable success with is actually life insurance companies. They are another lender that if you put your money in with a life insurance company, they expect to have that loan to the term of the loan, and it will be expensive to exit because they want to place their capital and get a consistent return based on exactly what the terms of that loan were. The nice part about them is they have varying flexibility on recourse, all the way from full recourse, all the way to non-recourse, and partial recourse. They have flexibility on their insurance requirements because it's their money that they're lending out. And also on occasion, if they like you, they actually can fund in part of the construction cost, which we've had some success with that. Bridge lenders, very high, expensive interest rates, super flexible on all the terms, but you're going to pay for it. So they're definitely something to be using only if you have like an extreme value add. This is the curve of the 10-year Treasury projected forward based on Chatham and the federal funds rate. And the reason I put this on one chart so it can be seen, the 10-year Treasury projections is a straight line moving up and to the right. The federal funds is the dots going down and to the right. And the reason that that's important is that multifamily financing is mostly based on either the 5-year or the 10-year Treasury, which typically run in tandem, not the federal funds rate. One of the things I wanted to highlight is we have these charts going back some years. So I went back 2 years ago and I took their predictions for 2 years in the future to October of 25 from what their prediction was of September of 23 to see how accurate it was. Because it's easy to make a prediction if no one ever looks back. It's just random numbers. I wanted to see how accurate they were. Their accuracy on the federal funds rate was almost 100%. Like it was astonishing. They predicted 4%. We're sitting at 4 to 4.25 right now. Like I was amazed at that. Now, they overshot the 10-year Treasury. They had predicted 4.75% for a 10-year Treasury today, and we're at 4.15. So they were 15% above where the real 10-year Treasury came in. So for me, Conservative. Yes, yeah. So for me, that's when I look at their predictions going forward, I'm going to use the lens of how they looked at things 2 years ago and assume that they're not being super optimistic on the 10-year Treasury. So we should have some safety to the downside. But I would also say the federal funds, I'm assuming if they nailed it 2 years ago, they probably have a pretty good algorithm on being pretty accurate going forward.
Why is the Treasury going up if the median federal funding rate is going up?
It's cool if we save it to the end for all the questions, because otherwise I'd be pontificating on for economics for the next 20 minutes. But we'll cover it back. That's a good, important question to make sure we cover because it's going to come up. One of the things I want to make certain is highlighted in this presentation is that there's two big components of multifamily lending. The first is where the risk-free rate sits at any moment. So we're going to take that as the 10-year treasury is a risk-free rate. You're essentially lending money to the government. So the lender can go, okay, I'm going to loan money to the government for 10 years at today, let's just say 4%. For sure I'm getting paid. If I'm going to take that money and instead lend it to Glenn, I better have some kind of risk premium that it's going to be, because I'm assuming Glenn's credit is not quite as good as the federal government's. He can't print money as far as I know. So there has to be some spread. And the important thing with that spread is it moves with the market also. And as the markets and lenders get more conservative and they're feeling pulled back and they're nervous about the future, that spread expands. And it could go to 3%. When they're feeling extra feisty and everybody wants their Christmas bonus and where everything's looking good, it can drop way down. To give you an idea, like if we go back to like 21 and yeah, let's just say 21, it was down around 1%, sometimes sub 1%. So not only was the treasury super low, but the spread was super low. And then as the treasury came up, everybody got real nervous and it blew up 2.5%. So it's important to understand the market. It's not just where the treasury is, it's also the appetite of lenders and how much risk they're willing to pay for. We're about to go into the interest rate. That's where these interest rates come from. Is it's not just that it's a 10-year treasury plus the risk premium that the lenders are looking for when they're selling it. The portfolio loans, hard money, essentially hard money. Agencies, these are agencies, that's Fannie Mae and Freddie Mac. Those are north of $5 million loans. If it's a sub $5 million loan, the loan is going to typically be between 75 and 100 basis points higher than the above $5 million loans. What's interesting in that case is if you're in the $1 to $5 million loan range, banks, as you can see, become super competitive. And it's something to keep in mind when you're shopping your loans. And that's why the vast majority of the deals we have been doing right now have been banks and credit unions, because when you add that spread for the small balance, the banks can be the same interest rate with flexibility on prepayment and with flexibility on insurance requirements, saving you a ton of money on insurance. So your extra cash flow is better. The downside with them is they are full recourse versus you're going to get the same interest rates, pay more for your insurance, but you can get non-recourse with the agencies. I'm going to have Glenn come and he's going to walk us through preparation for mortgages. He's recently finished some CCIM training, which I appreciated. I made him go sacrifice his several days and a weekend to go to CCIM and sit and study multifamily numbers, and I appreciate it. He's also been helping me on a ton of deals, so it's been really helpful, and I'm glad to have Glenn Booker come up and share part of this. There you go.
Oh. All right. So some of the recommended preparation. Now that we've gone through the market trends, here are some tips and tricks to look like a pro when getting financing. Number one, show me the money. Whether it's your money or your best friend's money, you need to show brokers and lenders that you have money, or what we call skin in the game, to get them to lend you money. And the best way to do this is with your personal financial statements, which could be produced by your accountant. 3 years of tax returns is also a great best practice, and showing your real estate portfolio. This looks better to brokers and lenders when you can show that you have real estate, which increases your credibility. Of course, having liquidity after the transaction is preferred, And being able to show where your money came from is also ideal. All right, so here for some best practices. If you want to be treated like an expert, here are some best practices for success. Number one, be sure to qualify a broker based on their experience in the multifamily space, their ability to close on time, and get you across the finish line. Time is money, and nobody has time to waste. Choose a broker over a lender because they have access to numerous lenders and they will use their experience and knowledge to best shop your situation to the proper lenders, saving you time and money. Now, we all have heard this. Proper planning prevents poor performance. So organize all of your proper documents. That's your personal financial statements, your tax return, along with the property's financial documents that you are looking to purchase. And one more thing to consider, avoid last minute red flags at the closing table. Bringing it up early so that you can properly frame your situation and the broker can explain your situation in the best light to lenders. Now, here are some advantages or the plus side to multifamily financing. When your rental income covers your debt service, you have what is left, and that's cash flow. Interest-only options also maximize your cash flow as you increase the property's value through modifications or better and increased occupancy. Have you all heard of the big, beautiful bill? I think that's yes. With it in effect, you can now get 100% bonus depreciation through a cost segregation study, giving you about 50% of your down payment back through tax savings. The most important advantage of using financing is that you now have more buying power. This way, your $1 million can now afford a $3 to $4 million property. And what is better than getting more money for your money? Now let's get Joe back up here to speak about the disadvantages and close out the meeting. Thank you.
Like that? Okay. That was awesome. All right. Risks to consider. This is when I do my Dave Ramsey joke. 100% of foreclosures happened on mortgaged properties. It is important to look at the advantages and the disadvantages of properties when you're using risk. I got a chance to be in this business through 2008, 9, 10. See a lot of properties go back to bank, work through properties with the bank, work through owners losing them. And it's a really good experience to get started at that time because I got to see the downside of risk. The biggest error, the thing that cost most of those owners was the balloon payment came due at a time when the market was illiquid. So the vast majority of the owners were suffering through, they were able to rent their properties. They had to drop their rents because we had negative migration. Like it was rough, but they were able to make the payments to the lenders. The thing that caught almost all of them was when their balloon came due and they could not refinance and they couldn't work anything out with the current lender. So for me, when I'm looking at risk on loans, the first risk is the balloon payment. When does that term come up? Right now, we're actually experiencing another risk that was not the case in that time. We had a 40-year, since the last time rates have jumped up that fast in a period of time of 12 months. It has happened 40 years ago, the last time it moved like that. And we got a chance to experience that in 2022, where interest rates skyrocketed. Now, I went ahead and took a snapshot. The 10-year Treasury, this is 5 years, 10-year Treasury from 2020 to 2025, up 491%. So that was borrowing cost increased by 491% on borrowers in that time frame. And if you happen to be sitting on an adjustable rate loan, you got a chance to watch your costs go up by 500%. And that could be a super shock if you were not anticipating it. That was not the case back in 08 and 09. 08, 09, it was the terms came due and lenders were locked up and you either had to cash in refinance. Those are the two major risks. This is one of the things when you have personal recourse is a big difference between having a loan with no recourse or personal recourse, because the decision on whether to save the property or not becomes real personal at that point. And it's something to keep in mind when you're taking on a loan is how long out am I willing to take the risk? When is the balloon payment due? What is my surety on the interest rate? The most conservative is lower loan to value, fixed rate, long-term debt. That's the very conservative route. It's nowhere near as much fun as the spicy short-term, get in and go max value. But to me, I don't know, for me, that's a much safer play. If anyone's asking what to do, that is the safe play. I would leave the more spicy things for people who are extreme experience. If you'd like a copy of this entire presentation and recording, you can check us out on Facebook and make sure to direct message us at 100 units or me personally. Just, hey, send us a presentation. We're happy to do that. To wrap through, number one thing right now, most active is banks and credit unions for the space that we are playing in. They're the most active, most flexible lenders, given some of the best terms. Always available for multifamily financing is Fannie Mae, Freddie Mac, because that is their job as a quasi-government entities to make certain at all times there is lending available for residential housing, which is their mandate. Walking away and understanding that fact that the risk-free rate changes and the spread that lenders are willing to accept a loan at also changes with the market. And those things are something that are outside your control. They're going to be in a macroeconomic environment, but they are very influential on the loan you can get. And it's incredibly important to look at where you are in the market cycle on when you finance a property or when you cash out refinance a property, based on when you see those spreads coming down or expanding. And finally is if you're taking on risk with leverage, there is risk in both directions. And it's important to keep that in mind and make certain you're making a good decision based on your situation and knowledge, and not just somebody told you it's a great idea to take a 2-year balloon and a variable interest rate bridge loan because trust me, you're gonna be able to raise all the rents 50%. So those are Joe's little recaps on finance. I want to say special thanks. These are the guys we talked to: Jim Haggett, Garrett Firestein, Dennis Amendez, and Dakota Brown, to get the interest rates and also terms that are currently available. Coming up in October is our Q3 state of the multifamily market for Central Florida. November, we're taking off. We're doing our 10-year celebration. And then in December, we will be back for fresh insights on our next Connect and Invest. And now, happy to take any questions we have from the chat or anywhere else. And I'll talk about your 10-year treasury question. And I appreciate the patience, so that way we can get it knocked out. We're good? Okay, sweet. So why would the 10-year treasury move up when short-term interest rates or the federal funds rate is moving down? We got a chance to actually see that really happen in the first quarter of this year with the 50 basis point drop in the federal funds rate. If you watched, the 10-year treasury actually jumped up almost a quarter point. This week, we got a chance to see them drop the federal funds rate, 10-year treasury up. Like if you look, from when they just announced it, or before they announced it, 2 days before they announced it, to after they announced it, it is up higher. Same thing. There's a number of reasons that people give for why. I'll give what I think, but honestly, it's just a guess, because predicting an entire debt market, I think, is really difficult to do. My personal opinion and the arguments that I've heard that make the most sense to me is the people who are lending for a 10-year treasury, that means you're essentially giving the money to your government and essentially locking it up for 10 years. They're predicting and taking into account that inflation is going to be running higher than what they would expect. And the main reasons for that is our government's deficit and the likelihood that it's going to continue, because essentially that's what a 10-year treasury is. That's the government borrowing money from the market. That's their way to borrow money. And when they run a deficit, they have to borrow more money. And so there's something to keep in mind, though, specifically about those 10-year treasuries is the federal funds. Everyone hears every 45 days, they have their open market meeting, they set the rate, and everybody, oh, were they going to move it up, down, do nothing every single time? What you don't hear about is their other huge lever that has a bigger impact specifically on lending in our space. They are currently letting their securities holdings, which include mortgage-backed securities, which include multifamily mortgages, 10-year treasuries, they have a massive holding, and they are letting that burn off. They can and have specifically multiple times gone into the market and said, we are buying these bonds directly. And if they decide we're going to buy bonds at 2%, well, guess what? Every bond is going to trade at 2% because they can just drive the market to whatever number the Fed, they have infinite buying power. And to me, that lever, it directly affects borrowing cost instantly. And they can just drive the rate to whatever they want it to because they just wanted to buy all bonds at X dollar. Like, we're willing to accept 4% for anything. Boom. We're willing to accept. And the whole market then is just reset instantly. And that's, to me, a much larger lever than the one you hear about the interbank lending, which is the federal funds rate being set at 4% or 4.25%. So this, though, is people lending money for 10 years. So their anticipation is, and the reason they're saying this curve is in this way, they're saying, we don't think that someone is going to lend money to the government for 10 years, lock it up, and accept a sub 4% return. Because inflation, if it keeps running at 2.7 to 3%, well, your real return is 1%. And that's a super thin spread. Now, if you thought inflation was going to drop to sub 2%, I think you would see those curves coming down a lot more. But I don't think a lot of people see the government becoming fiscally responsible and no longer running massive deficits.
Is that all agency and banks and credit unions go off 10-year treasury and insurance companies?
The vast majority. So they're going to look at the risk-free rate to them, which is going to be, if you're getting a 5-year loan, it'll be the 5-year treasury. If you're getting a 7-year, it'll be the 7-year treasury. If you're getting a 10-year, it'll be a 10-year treasury. If you're getting 20-year, it'll be a 20-year treasury. Because they're going to compare, when they loan you the money, their anticipation is, for most banks, it's actually a 5-year, because most bank loans are 5 and they do 5%. It'll be 5 years fixed. It'll reset based on the 5-year treasury for the next 5 years, because their alternative investment is put the money in the treasury. Like, that's it. Like, there's no reason to, you can lend it to you or they can lend it to the treasury.
Okay. Are there groups? So is there anyone, them or the treasury guys? The reason I think about this is because if you buy a deal today locked in for 5 or 7 or 10-year term, does that then mean you should be anticipating a 100 basis point increase in the cap rate when you go to sell it?
That's quite possible. If the 10-year goes up by 100 basis points, I would think that that's a reasonable anticipation.
And you should do that. You calculate the exit cap rate.
Mm-hmm.
You should add 0.1% conservatively, 0.1% per year, based on what you're currently at, market cap rate.
They're like, so you can see they were off by 15%. They were on the conservative side. This is 2 years ago when they made these predictions. I mean, they were spot on with the Fed. Like, honestly, that's like, I'm amazed anybody could predict that good. This being 15% off, I think, is honestly pretty good too for a 2-year forward projection. But if you're looking out and you're saying, okay, I'm going to buy the deal in 2025 and I'm going to sell it in 2030, 5 years from now, well, there you go. They're expecting the 10-year treasury to be at 5%. That means your borrowing cost is going to be plus or minus 6.5 to 7. Well, if you're borrowing money from a bank at 7%, you're probably not selling it at a 6 cap. Now, they were also, in 2 years they were off by 15%. So that could be, that means it could be here, it could be here. But I personally, if I was looking at an exit 5 years from now, I would definitely take into account that most of the forward curves for the 10-year treasury are moving up. And you can actually buy spreads like that. Their business is amongst other things is actually they sell the spreads. So when people do, like, they buy a variable interest rate, but they buy a rate cap, these guys sell them those caps. And that's one of their things. The Chatham Financial, that's one of their things. They sell that. Yeah, you can buy that. They literally have a market thing, and it says how much. If you want to buy a 1% cap, here's what it costs. You want to buy a 2% cap, here's what it costs.
So because I'm looking at that quotes right now for the deal I'm working on. That rate cap money would go to Chatham Financial, and they pay they do something for the lender, and the lender gives you a better rate.
No, it's the other way. It's if they would cap, like, say you buy a variable interest rate loan, so you get a lower rate today, whatever. Instead of getting 6%, you get 5%, right? But it's variable. You buy a cap on it, says it cannot go more than 2%. And if it does, then Chatham kicks in.
That happened a lot in 2022. They bought it at 2%, 2.5% interest rate variable, and they didn't cap it. So when it went up in those 12 months mark, that was crazy. And then they don't have exit because it's at 7-8%. So they're losing money because they have to liquidate the property.
Yeah.
There's no cash flow.
Yeah, the only time you'd buy a rate cap is if you're getting a variable interest rate loan.
Oh, I was thinking about buy down.
Okay, that's the invert. Yeah. So that would be the opposite. You're actually prepaying the interest. This is a cap on a variable. If you're going to get a loan, yeah, and you're getting a variable interest rate loan, I would say today they'd almost make you buy a cap.
Right. Okay. When you kept mentioning banks and credit unions, is it okay for another question?
Yeah.
Who are the banks that are most active in the small balance space right now? In this,
what size? Give or take, like, what size loan? $3 million loan. We've done deals with ViStar, Brightstar, Addition, Fairwinds. We haven't done it. Bank Financial was really active, and then I haven't done anything with them in a while. But they closed quite a few loans a few years back, and I don't know. They haven't done. I'm trying to remember the last time I think I did one like 2 years ago with them. I will tell you, if you're going to be shopping for loans, I would call one of these guys. Like, seriously, all these guys are real good. Like, if you're looking for a bank or credit union, Dakota is really good. Garrett Firestein is really good. If you're looking for Fannie Mae, Freddie Mac, Dennis and Mendes, that literally at CBRE, that's all they do. They only do Fannie Mae and Freddie Mac. That's it.
You stress this a lot, that I've talked to Garrett and Dakota before, that the banking credit union will have lower insurance requirements compared to Fannie.
Correct. Yeah. Oh, yeah. Compared to it, so Fannie Mae and Freddie Mac, for sure, you're going to have law and ordinance insurance. You're going to have terrorism insurance. You have business income loss insurance, and they're going to be very strict on wind insurance and property casualty loss. The banks and credit unions, typically, you're not going to have terrorism. You're not going to have the law and ordinance. You're not going to have business loss insurance. And they're flexible on the windstorm and also flexible on the coverage specifically of the property and casualty. Yeah. Yeah. And the prepayment penalties, they're going to be way better on prepayment penalty because you get a Fannie Mae and Freddie Mac and you're in it to win it. Like there's one way out.
Like if they have the multifamily portfolio and this credit union is already full, they're going to give you a higher rate than this one that they need to fill that up. So, I need to fill that multifamily portfolio loans, so I'm going to give you a better term, so you get this one. You did the deal with us.
Yeah,
that's
one of the because the thing is, like, who's lending a lot today may not be. I'll give you an idea. Like, I was doing deals. We did like 3 deals with one lender. Boom, 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 just right. Like they were like great. And we go to him for the next loan. And he's like, "Oh, I'm busy. I'll get back to you." I'm like, "Dude, can you get a hold of the guy?" Can go. Finally, I like caught him. I was like, "Dude, what is going on? Like, we just all these deals. Like, let's go. We got another one just like it. Let's go. Let's go. Let's go." He's like, "Look, man, let me call you later." I'm like, okay, so he calls me out of his office. He's like, "Dude, we ain't winning nothing. Like, we're done." And literally, we had just closed the loan like 2 months before. But their bucket, they have very specific buckets. But if you don't know them, they will never tell you that. Like, you will never see that public. You will never see it anywhere. It'll just be, "Oh yeah, we'll get back to you. We'll get to the underwriter. Oh yeah, we'll go to the whatever thing. Oh, we're on vacation." Like, that's really what's gonna happen. That's why if you know these guys, they have real good relationship, and they'll get the cell phone. Yo, dude, ain't happening. Like,
and they will give you the option.
They'll give you, "Hey, here's the 3 guys that didn't loan for 3 years, but now their bucket is open because because they got paid off, because whatever, and now all of a sudden they have, and then boom, all of a sudden they haven't done one deal in years, and all of a sudden, bam, they are super aggressive because their bucket is now empty, and you just won't know that from the outside." Yes.
Back on when you were on the treasury curve.
Oh yeah, everyone's favorite. Is this Joe's predictions of the future? We can look back 2 years from now and we'll see how accurate I am.
Lines of, if you get an interest rate loan at 7%, we shouldn't think we will sell the product at a 6 cap.
Yeah.
Okay.
I would find it incredibly unlikely that if the interest rate on a mortgage is 7%, the cap rate that a buyer is going to be willing to accept is going to be below that number. Like, I think that would be very optimistic. That would be an extremely unusual circumstance. It is almost always going to be 1.5% above that. So if there's a spread, because otherwise, why buy a property to lose money? If you want to lose money, there's a lot more fun ways. You can go to Vegas and just lose money. Yeah, go ahead, Ronnie.
I just want to, I missed
Yeah, it was alright. It's dumping rain over here, man. It's tough. Oh, that's Omar asked the same thing. He's like, "How is this possible?"
Why they're going in opposite directions, but multifamily financing is going up. That was specific.
No, but treasury actually goes up with that.
Mm-hmm.
And what is the is 2025 here?
So this was so I went back and looked. So in 2 years ago, their predictions for the Treasury today, 2 years ago, they predicted the Treasury to be 4%. I mean, literally, they got it perfect on. This one, they predicted the Treasury today to be 4 3/4. And reality, we're 4 15. So they were more conservative with the 10-year Treasury. The argument for why it's going up is typically the one that to me makes the most sense, is that we're going to continue to have government deficit spending driving up inflation, which means that people who are lending money, buying 10-year treasuries, or lenders are going to command a higher interest rate to make up for the inflation that they're having to absorb. Now, it's a a prediction of the future, so there's a lot of guessing.
Is it 2 years protection?
This is this right here it's a 10-year prediction. This are 26 to 36. It's a 10-year span. And they're predicting that the federal funds is going to keep basically hover around 3 and stay there. But what they're also saying is their anticipation is inflate. Basically, they're essentially saying they expect inflation to run a lot hotter than what it has in the last 20 years. Now, please understand that's a prediction of the future. So we're, my magic 8 ball is is only so.
Inflation going to go up, then you're not going to see the Fed on the same rate. It's probably going to go up. So I think something's wrong with this.
Or they could be wrong and it could come down. Like we actually talked about that this one is driving the federal funds rate. The other big lever the Fed has, they can just go in the market and buy, and do quantitative easing where they essentially just buy bonds, which will just put the interest rate at whatever they want it to be. Sorry, go ahead.
Oh, this has absolutely nothing to do with that. You
Oh.
mentioned he got something to do with CCIM.
Yeah.
I've never heard of that. I was curious what that stands for.
Oh, yeah. It's a lot of training. It's a bunch of work. Yeah. Awesome. Thanks for coming out. I appreciate it, everybody being here. Our next one will be in October. Next one will be in October, and we will see y'all then. So, Nikki, are we good? Awesome.